Alright, welcome back to another video. And this one we're gonna go over how to spot the trend change utilizing imbalances of the market. Um, Basically, what an imbalance is a gap in the market. So from this wick to this wick, there's no candle here. There's no wick. You feel me? There's no candle on the other side. So we would consider this a gap. Let me draw it out. We consider this a gap in the market. All right. So on the sell side, what you want to look for first is for a price to be trending up. So right here, we had a breakup, started making higher highs and higher lows, and then something happened right here that caused the trend to change momentarily. And remember, we scalpers. We try and get in, we try and get out. So this formation right here, these three candles, is what I call a continuation killer. Is when, let me delete this. It's when a bullish or a big bullish or a big bearish candle, but in this case a big bullish candle, is traded through. So the low of this candle right here, that's the candle low of this bullish candle, and price traded through it. So this candle traded below the low of this base candle. So consider how big this is, and this is the last high before it made its transition. This would be the base that price traded through, and from there on you would trade it as, you would mark your zone. This would then be an order block or a POI, a point of interest. So what you would be looking for is for a price to push away from the zone and then come back into it and then trade away. What I mean by that is in real time. This is the 5-minute chart. So after you have your zone marked up, after this happens, remember doing a uptrend, you're looking for it to reverse and go to the sell side. So after you have your zone marked up, you would then go down to the 1 minute. So you have to be doing this in real time, and these trades are going to hit TPs quick. So you will go down to the 1 minute, and in real time this was the candle push away. So now you can either wait until it breaks structure. You can mark out your support resistance. This is support turn resistance. You can take the trade that way. Take it as the tap of this zone, or the closure below this zone right here, as it starts to reverse and close below this bullish structure. Or if you didn't catch an entry down here, we had this big leg of structure right here. Normally after this happens, there will be a retracement. So you could also mark out your zones from these wicks, where the majority of the wicks are, and you could have called a trade or entry off of that. Again, either off the tap of your zone or an engulfing candle, which would be these two candles right here, this small blue one and this big red one. The red one is way bigger than this one, so that's what you would call an engulfing candle formation, and that's a candle entry off of any zone depending on your strategy. At least for me, that's the that's the only one of the three that I use. I would say almost 100% of the time. So say you got in off of the rejection either here or here. 14 to 20 pips, like I do in my like I say in my course, or depending on the trade, you can go above the zone, which you would be risking 5 pips, and you can target this leg of structure, this low, this low, this low. It all depends on you. And considering the fact that this is the 1 minute time frame, this was what TP if you would have targeted this low. What is like 4 minutes, 5 minutes, 12 pips, risking 5. Or if you want to target this low right here, you would have been in for about a good 15, 20 minutes. But still, that's you're risking 5 pips, which depending on your lot size could be $50 on gold to make 28 pips, which would be 280. It also depends on your leverage as well. So with the 1 to 100 leverage, with a standard lot size, that would be 280. All right. Where we at? Where we at? Where we at? All right. So again, let's go from the beginning. When you're looking for sales, you're looking to catch basically or potentially the the end of the up move. So right here again we have it broke structure. We had high, lower high, lower low, lower high, lower low, lower high, lower high. It broke this final lower high, which transitioned it bullish momentarily. Then we started making higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows. And when at this point right here, this big bullish candle, once this big bullish candle was traded through, that's a signal or a sign that that price wants to reverse in that moment. Like again, this is not gonna happen every single time this happens. But that's where trailing your stop loss come in. I had a video in my course about that. I'm not gonna go over that in this video. Alright, so uptrend, bullish base candle to be traded through at the last high of the uptrend. Mark your zone from that big the big bullish candle. Go down to the 1 minute. Your entry would be either the top of your zone that you draw out, or this box right here, for instance, or a candle formation, the engulfing candle formation, or just a rejection candle, which means that since you're looking for a sell, any red candle on the 1 minute in this area would be an entry. That's just saying if you miss this and then catch it down here. So let me delete this so you don't get confused. And this too. Alright, so after you got your zone marked up, you go down to the 1 minute. And once it hits this zone again, like once this red candle was out, any candle that comes back into the zone, that's a tap. So the first tap back into the zone was green, or blue. Where I get green from. So that wouldn't be considered an entry. Now one of the entries is a rejection candle, which in this case would be a down candle or a bearish candle or a red candle. So your entry could have been right here. Again, 20 or 20 or 14 pips, depending on the trade. Or, you feel me, you got zones that you can put it above and you can risk less. But I would suggest using structural zones instead of just, you feel me, putting it above a random wick. But since we have minor support term resistance right here, you could have placed it above this zone, like above this wick. But like I said, it all depends on the trade at that current time. All right. Let's look at the sell side right after the buy side. Let's look at the transition. All right, so from here we have high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, and this is a lower high in this area right here. Now, a better way to spot it would be, yes, the candle has to be big, but another way to spot it would be, or easier way would be an engulfing candle formation. So when a high is made, or when a low is made, when that engulfing candle formation gets traded through at the very last high or low, depending on the trend, that would be a confirmation that the trend is trying to at least change for a little bit. So right here we had this engulfing. This was the last high. We had a 4 candle retracement. That ended up getting engulfed. Then we had price actually come through and close above the body of this engulfing candle formation. Once you pushed above, price came down into, this would be considered supply. I mean, not supply, demand, or a bullish order block. But again, those videos will be coming soon in the course. So we had this close above the body of these candles, of this engulfing candle formation. So then what you would look for in this scenario would be a support or resistance type of entry. So majority of the wicks were in this area. So say as price is coming up, so in real time, after this candle closes, then you'll have your zones marked up. Now you'll be looking to get in. Now you can either get in on the 5 minute or you can get in on the 1 minute. On the 5 minute, you could get in just by the closure, or if price starts to come above these wick highs, or you can go down to the 1 minute. Where was we at? We right here, okay. Or you can come down to the 1 minute and trade the breakout or the break and retest, or when you get an engulfing candle after a break and retest in your favor, which would be this candlestick formation right here. It broke out of these zones right here with this candle, came down, you had an engulfing candle. That could have been your entry on the candle close, or as it started to go above this wick high. Put your stops below, 1 to 2, and you out of there. Now, sometimes what I will do, if I like the setup and I like how the market is moving, once I get to a 1 to 2 risk to reward, I'll take a partial, and then I'll leave the rest in, and I'll target. Could have targeted this high, or this high, depending on how price is moving. But as you feel me, as price is moving up, you would want to place your stops below structure. So what I mean by that is, once it breaks, let me zoom in, get this off of there. So once it breaks structure, you could put let's say your stop loss was down here below the zone. Now you can move it up, say near these wicks. When it breaks structure again, with your stop loss below this structure. When it breaks it again, move it below this wick, move it below this structure, and just trail it like that. So by the time you're up here, if it's moving like this, a way you could trade it is by doing the candle lows of each candle body. Because if it's not making structure, then that's all you have to go off of. Alright, let's run through the buy side again. When price wants to transition from a downtrend to an uptrend. Alright, so again, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. That was the final lower high it got traded through. Price closed above the body of this engulfing candle. Broke out, retest. The rest of history. Now, you don't really have to worry about pips unless you're worried about your stop loss. And when you're dealing with that, then you would just adjust your lot size. So if you're not willing to lose $200 on a trade, then just lower your lot size. Still target the same highs. Still place your stop loss in the same area. Just lower your lot size. All right, now moving forward, we had this huge pullback, and then it started making higher highs, higher lows again. Right here in this area, it started to transition, but it wouldn't be considered a downtrend transition until in this point in time. Why is making this price action right here? It wouldn't be considered a downtrend transition until close below this low, because these lows never led to a new high. Well, this one actually did, because this candle body closed above these candle bodies. So this one never led to a new high, so you couldn't, even if it came down here, you couldn't, as long as it didn't close below, you couldn't consider it a structural break. It would just be support. Now, the second low that it did create did lead to a new high, and in this area we had the same type of pattern, I would say, the continuation killer. So you have this high. It was kind of an equal high to this one, so you can't really count it as a new high, but it led up to this high right here, and we had this was the last minor low, so this would be our base. So if this gets traded through, then that's when we're looking for, again, the bearish transition or the downtrend transition from an uptrend. Because right here, this was basically like a minor consolidation phase. But right here, we got the confirmation that price at least wanted to go bearish for a little bit. Now with this one, since there wasn't a engulfing candle that was traded through, there's a few ways you could have traded it. You have this order block, didn't really come and tap it all the way, or once you notice the transition, you can mark up the imbalance that price creates, would be, again, the gaps that we talked about before. So going from, let's go back to that. Say if we were in an uptrend, we would be looking for buys. So once we get a pullback and then price takes off and we're waiting for another pullback, these gaps or spaces in the market or the imbalance in the market can help you determine where to get in at, because you actually could have called this buy off of this uptrend. So say we're in this area right here, none of this happened yet. and we get these three candles. We have an imbalance from here. Really, it'll be up here because that wick is very small. But we have all this space for price to come back into and trade out of. Now, since it's so close together, I would look for an entry off of structure. So we have structure right here. We have these wicks that created a minor roof that then got traded through from here. But let me get this out the way. You could trade it. You could have traded it like this. Went down on since it's so close together, could have went down in 1 minute, got an engulfing candle formation, and then targeted the body high or at least the wick high. Or you could have waited on the 5 minute, got an entry from here when this candle engulfed this one, and targeted the body high or the wick high. So there's multiple ways you can get in on this strategy. You just have to pay attention to price action. So when you get higher highs, higher lows, higher highs, higher lows, and then a bullish, which in this case would be blue, gets traded through, which means the opposite candle or the red candle closes below the body low of that candle, which would be the bottom of the candle, then you can look for price trying to transition. Then you will mark your imbalance, go to the 1 minute, look for price to trade back into it. You get your engulfing, or the top of the zone, or a rejection candle, depending on the trade. So in the bullish trend, your rejection candle would be bearish. In the downtrend or a bearish trend, your entry candle would be bullish because you're looking for the reversal. So in downtrend, you're looking for a buy at the very bottom after you see the transition. After you see price close below the very last lower high in the downtrend, then that's your transition. You mark your zones, your support resistance, and then you wait for price to come back into it. Then you get your entry either on the 5 minute or the 1 minute. You can either go off of, again, the engulfing candle, or as price starts to come above these wick highs, as it starts to break structure even more, basically. Now this right here, I marked this up today, January 17th. This is what I anticipate, but it started to break more structure. So say from right here, let me see if I can, let me mark it up in real time to end it off. Alright, so we had a downtrend, came from up here, high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Now, during this point right here, we have at the very bottom of this trend, because up here, every engulfing candle did not get traded through. Price did not close above it. This is engulfing, price did not close above it. Here's another engulfing, price didn't close above it. They was just basically creating bearish order blocks over and over again until price actually wanted to break structure again. So that's why that's marked as leg of structure and not many micro higher highs and higher lows within this leg of structure. But right here we get the same pattern. We had, this would be our, wait, I'll leave that right there for now. So we had this lower high, lower low. We had this 2 candle retracement. So that's our last lower high, which led to an engulfing. Price closed above it at this point right here. So you can either mark, then you have to mark your POI, your point of interest, where you want to get in. So we had a structure, in this area. We have structure in this area from where these wicks are on the other side. And this candlestick formation, or this whole, basically like a W, would be called an inverted head and shoulders. This would be the shoulder, this would be the head, this would be the other shoulder. So you can mark these structures and then do the same thing. It's just support and resistance. So we had support, turn resistance, we had support, came up through it, traded back down through it. This was support, turn resistance for a little bit, came back up to it, came back, use it as support, traded above it, resistance, support, so on and so forth. But yeah, that's the strategy. So utilizing imbalances this way, I found it to been very easy figuring out when to get into market, when to get into the market, and how you can get into the market at any point of the session that you managed to get in on. You managed to catch the market on. And with this strategy, I've learned that with doing it and back testing it and trading live, that you will potentially catch the bottom of a trend. Like your risk of actually getting at your percentage of actually catching the bottom will increase with this strategy, as you've seen in real time, because the market is actually open. This was 4 p.m. Later today. At the time of this recording, it is 7:24 p.m. So we had the transition right here, came up, retested these structures. You had you engulfing, and say if I would have got in on that after it retested this structure, put stops below, target this high, or you can go to a 1 or 2 if you don't want to target highs, but target this high, this high, this high, this high. It's already on its way to this high. It already came to this one. So it all depends again on the trade. But yeah, the Discord, well, not Discord, Telegram will be in the description below. I will have a Signals chat or a Signals Telegram coming soon thereafter. Telegram will be released. I'm gonna give it 4 days from now. So what's that? Saturday, Sunday? Yeah. So the link will be released Sunday. We get in there, trade together, learn and earn, learn why you trade with me, and eventually I will be doing lives where, like live Zoom calls or going live within the Telegram, and we can all trade together during New York session. And I was thinking about doing Tokyo session, but that'll come later. But yeah, that's strategy. Peace and love.